We always think that we're going to be able to save more later in life, but to be honest, life doesn't seem to get cheaper as you get on. You get bigger houses, you get newer cars, your children have more and more expenses. So it's really just getting into that pattern of saving and saving what you can as you can. I am Steve Eiding. I'm part of the Private Wealth Management Department. So while $1 million is a common savings goal, what you really need depends on what your goals are during retirement. What we recommend is that people sit down with their advisor and look at what their income and expenses are going to be in retirement. From there, you can create a personalized financial plan that will help you decide what it is you need to meet those goals. A normal standard would be 60 to 80% of your pre-retirement income. To help meet your goals, it's best to have a personalized retirement plan done, where we can look at your assets, weigh them against what your expected expenses are, and come up with that goal, rather than come up with just one large dollar amount that you're trying to attempt to save. You should start saving for retirement as soon as you can. Due to the power of compounding, really the earlier you can get even a little bit of money saved, it will definitely help you in the long run. We encourage people, even with minors who have a part-time job, to maybe set up a Roth and begin saving just a little bit for retirement. That way their kids can get into the habit of savings and they see some of that growth occurring, and they can really get excited about how the power of compounding can help them. When you get into your 30s and 40s, you're really in some of your peak earning years. So you want to try to increase those savings that you can make. You know, it's very important as soon as you do start saving or get into a company, if they have a retirement plan, to begin saving it as much as the company will match. And then what we recommend is that people look at what they're saving on an annual basis and try and update that percentage at least 1% per year. Depending on what your goals are during retirement, the earlier you retire, you may need to save more due to having to pay for more medical or healthcare expenses. Health insurance can be a big goal to achieve, especially if you plan to retire before age 65. And again, depending on your standard of living, if your goal is to take exotic trips and cruises, you're probably going to need to save more than the average. Whereas if you're comfortable and have your house paid off and like to stay home and do volunteer work, you may not need as much saved for your retirement. It's very important for everyone to have an emergency fund. Studies have shown that up to 50% of the people in the United States cannot afford a $400 emergency. Studies show that you should have 3 to 6 months worth of savings in an emergency fund. Well, that's a great goal to get to. It's very important to have at least $1,000. That way, if a car breaks down, a refrigerator dies, you can go ahead and get those replacements. As you get older, you want to become more conservative with your investments. So while you're young, you want to start out and be fairly aggressive, not with the money that is in your emergency fund, but with the money that you're planning on saving for retirement. So while the market may be volatile, those with a longer time horizon to invest can take on that volatility, but with that volatility, usually there's a higher chance of getting a better rate of return. You want to continue to monitor what's called your asset allocation, your mixture between stocks, bonds, and cash, and make sure that your investments match up properly with the amount of risk that you're willing to take versus the expected return that you're trying to get. During your 20s, really your goal again is to start investing as soon as you can. You want to be very aggressive with the money that's going to be saved for your retirement. And then during your 30s and 40s, you may want to dial that back a little bit. And again, this is the perfect time to begin adding a little bit more each year to those savings until you reach that level of savings that you're comfortable with. Again, falling back upon that plan that will help you reach your goals. As you get into your 50s, the IRS does allow you to make additional contributions into either your IRAs or your corporate retirement plan. Those are called catch-up provisions, and you want to make sure that if possible, you know, at this age, your kids may be coming out of college or graduating high school, so those expenses may be falling away, or you've had a couple of raises, your mortgage doesn't take up as much of your income as possible. So you want to take advantage of those IRS catch-up contributions to really kickstart or boost the savings that you already have in there. I am Steve Eiding, and we are Minster Bank.